Cash flow projections and the monthly review process. You know, a number of years ago, I stumbled onto something sort of by accident, and it was based on some conversations I had with my wife where she saw what I went through when I started my own business, and then she would see a lot of the clients that came in my door for my help with their bookkeeping and their financial accounting, and she would ask me why they didn't, sort of do what I did in terms of planning their business, which was really a bunch of financial modeling and toiling over spreadsheets. And I explained they're not accountants, they don't have that skill set, they're really good at whatever it is they do, selling widgets, making blueprints, whatever it is that they do, but they don't necessarily know how to do financial modeling and accounting. So in a sense I had an advantage because I had this background, and I also had the propensity to want to learn how to do this kind of stuff, because not every accountant does even have that kind of Excel or spreadsheet training. So long story short, I developed what evolved into what's called Nerd's cash flow projections. And the short answer is I would take people's financial statements from QuickBooks, export them to Excel, and build out a cash flow projection where I'm projecting the balance sheet and the income statement and the statement of cash flows out as far as I want to. And once that's built out and balanced, it's really easy to create schedules and flow them back to the appropriate places on the balance sheet and or the P&L, and then the statement of cash flows calculates from there. So I was able to develop these tools that clients could really use, where we could go in and change scenarios and review them every month and compare the actual to what we had projected and see where we need to make adjustments and make sure that we can explain the significant variances and do really what previously I thought it was very high level stuff that you would have to hire a very fancy MBA to do. And the reality is I felt that what I created was actually much more useful than what most MBAs would even create if you hired them to do a financial model. They pretty much just create it and hand it off to you and say, okay, here, have at it, here's the bill. And as I explained in the write-up, when the CPAs are hired to do it, they're bound by certain regulations. They can't give you that dynamic spreadsheet document that allows you to change assumptions and look at different scenarios. So I found that I was able to create a powerful tool that lots of small business owners have now benefited from. And you got a taste of it when we looked at last week's post on sort of financial statement strategies and strategizing around, how to purchase fixed assets and how to make sure if we finance that we pay it off at an aggressive enough rate so that we still maintain an increase in our equity on our balance sheet. So now what I want to do is actually show you a little bit of a deep dive into that same template and show you some of the how, a little bit about how that works. All you really saw was that it worked, and you saw the impact, which is what I designed it for, was to show you how different transactions would impact the financial statements. Now I want to have you come over and take a look at my screen, and we're really going to dig into the cash tab, which if you noticed, I didn't even go into last time. The cash part was all calculated automatically. Let's take a look at my screen, and I'll show you exactly what this looks like and what I'm talking about. So over here on the spreadsheet, again, I'm looking at the balance sheet. And if you remember, we started the business off with about $200,000. Not about, we started it off with exactly $200,000. And then we ran some scenarios where we said, let's say we purchase a fixed asset for $50,000. And then I financed that same asset ultimately for the same $50,000. And then we assumed $3,000 a month repayment of that loan. Now what you may or may not have noticed was that the cash adjusted accordingly. So if I go back, for example, and I take out this assumption, you may wonder, how did we balance, right? If I go back to the balance sheet now, look what happens. My cash is now only $150,000 instead of the roughly $200,000. There's also no more interest expense being factored in. Right? So there's no loss from the net income closing for the interest expense. In fact, if I go over to the income statement, we just have that expected return on assets, and I've also got my depreciation expense. That still figures in because I have the asset and it needs to be depreciated. So the cash is kind of figuring itself out automatically, and it's not really so magical. It's because I've written formulas here. And this is how it works. What this is a very, very simplified version of what the statement of cash flows does, where I sort of programmed it to look at changes in balances to accounts receivable, or changes in balance in balances in accounts on the balance sheet. So it has accounts receivable. There's the owner's contributions, which is picking up. If I went into the owner's contributions in February, and I figured in, let's say, an additional $25,000 contribution, that's going to flow back to cash, and it figures in right here, and it adds that to the balance. So each month we have the starting balance. The activity is what happens in between. And what this is doing here is it's analyzing different things in the model that I've created to figure out what the impact on cash would be. So let's take that extra $25,000 back out and go back to cash. And one of the things that I have it looked at is this fixed asset financing. Notice right now it's 0. But what it's doing is it's looking for changes in that account based on what I put here in the short-term liabilities. So if I do go back and assume that we're going to finance the fixed asset, what that's essentially going to do is without the financing, it subtracted the $50,000 from cash to assume that it had to be paid cash if we didn't borrow the money from somewhere. So when I put the financing in, what it's going to do is it's going to essentially add that money back to cash because, it subtracts it out based on the increase of the fixed asset, right? This number right here on fixed assets increase or decreases cash. So this number here, when we say no, we're going to finance it, that actually adds it back. So let's go see what that looks like back on the cash tab. Sure enough, the purchase assumes that it comes out of cash initially, but then we have the financing, so that goes and says, no, let's add that back in because now it didn't come from cash. It actually came from the fact that we've now financed it, right? And then when we figure in the repayments, right, I said minus 3,000, right, and everything, I just set the rest of it automatically equal to that. So notice the ending balance now, instead of being 50,000, is 47. Back to cash, that's where it's picking up this balance from, right? Initially it starts out and it says, okay, we have 47,000 in there, and then every month thereafter we're reducing cash by 3,000 because of the change. Here we're only adding back 47,000 instead of 50 because we added back the 50 less the minus 3,000 that we paid. So that's how my cash on the balance sheet is getting figured out automatically. And that's how creating a model like this can be incredibly helpful and useful. It allows me to look at scenarios that enable me to do the right planning so I can look at what I expect to happen and sort of program that in, plot that out in a model that I usually will take out a year or up to 18 months. I figure beyond that is pure speculation. We don't know what's going to happen beyond 18 months, 2 years. The standard financial model is to do a 5-year plan, and again, beyond 2 years to me is it's meaningless. It's pure speculation. So I like to take it out to a year up to 18 months and use a tool like this that I can easily build in. Building it like this makes it very easy to customize. I've looked at a lot of tools over the years, and I continue to look. I'm still looking for that one tool that's going to make it so I don't have to do this in a spreadsheet, and I have yet to find the tool that gives me the flexibility, the ability to be as specific as I can be here in terms of what I want to project and in what, and in great detail that I can project. I can take any line item out of my profit and loss or my balance sheet and break it down into the most excruciating detail if I wanted to be as specific as I ever wanted to be. I practically build my own accounting system in here, but it's an accounting system that gives you, instead of what we call history reports, right, which your balance sheet, your P&L, it's all after the fact reporting. It's telling you what already happened. So these are how I create what I like to call let's make history reports. And that, my friends, is your cash flow projections and the monthly review process in somewhat of a nutshell. As always, I hope you learned something and had some fun along the way. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.